going to continue to take market value as the US dollar continues to debase. Bitcoin will continue to rise in value. It's that coefficient. There's just no way around it. Now, I did share something with I'm going to tease Dave back up here. I did share something, Misha, if you could bring it up, because I've been saying this for so long that you have Bitcoin got way ahead of itself. Yes, we all agreed. So the question was Bitcoin going to correct down 50%, or was the money supply going to come up and meet it somewhere? Well, we can see what's happening. It's meeting it. Remember, this is a money supply curve that's delayed by 3 months because it's the way that because Bitcoin lags. But look at where it's about to touch.
With equities and cryptocurrencies experiencing exceptional volatility, the financial markets are once again at a turning point. James Lavish claims that the tighter liquidity constraints and changing market mood are the direct causes of this volatility. He highlights how important it is to comprehend capital flows and market cycles in order to make future predictions. Additionally, the effects of broader macroeconomic developments are being felt by Bitcoin, which has recently struggled to maintain its pace. Interest rates, monetary policy changes, and institutional demand are some of the major elements influencing Bitcoin's course, according to Lavish. Right now, the key question is whether markets are ready to recover or if more suffering is to come. Take a moment to like this video, subscribe to the channel, and turn on notifications for more content on Bitcoin and the digital asset space. Also, drop your thoughts in the comments below. It helps with the YouTube algorithm and supports the channel. Thanks, and enjoy the video.
If you look back to last few prints of inflation, you could say, oh yeah, inflation's coming down. It's still stuck well into the 2% range. It's like 2.5 to 3% range. PPI numbers were over 3, so which is the producer price index. You've got uncertainty about Doge, how many jobs they've cut, how much of that spending coming out of the government, which was, we can all agree, last year, there's absolutely no question about it. The Biden administration was juicing the economy by hiring, uncontrolled hiring at the government level. And so now we're kind of clearing that out. How much is that going to impact us? How much is going to impact the housing market in DC? How much is it going to impact the spending out of DC? And then all of those people who are now unemployed and crying about it because they weren't doing anything and they don't have jobs now. Welcome to the private sector, everybody. So now the question is, how much pain does it cause for Doge to come through here and clear house? Just start, burning the weeds and the brush and getting it cleaned out. Well, we're going to find out pretty quickly. On top of that, we have tariffs. We have now the threat of, and real tariffs are coming, that are coming down the pipe right now. So is that going to be inflationary? Remains to be seen. So again, uncertainty. How much of that spending, we've cut about $200 billion, just under that, according to the debt clock. How much of that spending is going to impact the economy remains to be seen. All right. So I shared a window here, Misha, if you could pull that up for Noel. But Mike is right. We've been talking about the mean reversion for a while. And the question is, was there going to be enough liquidity to meet the expansion of multiples on the S&P and the NASDAQ, or are we just going to have a drawdown? Well, we've had the drawdown, one of the fastest corrections in the history of the market. This is, top 10% drawdowns, fastest drawdowns in the history. All right. So we can all see that, yeah, it's due for a bounce, just like Mike said. Is it going to bounce? Or are we going to draw down further? One correction that I want to make on Mike is that Bitcoin has actually drawn down 30% from its all-time high. And so it has had a real steep drawdown here.
I use closing basis. Okay. Close to close. It's something you can actually trade. Selling the high and buying lows. I use actual closing basis.
Yeah, well, Bitcoin doesn't close, but that's fine. But
VWAP, then a VWAP price in the close.
Okay. So, but the reality is that we've had a really steep drawdown here, and we're finding, footing. Question is the money supply expanding quickly yet or not? And the answer is the money supply is expanding. The question is just, how quickly is it? And Bitcoin does lag all of that. So it's been lagging 2 to 3 months on the money supply for years. And so you can go back and chart it right against the global money supply and it follows it lock and step. So did it get ahead of itself? It did get ahead of itself, and now it's drawn back. So we are not going to get a Fed put until we have more of a correction. I agree. We're not going to until we get more of a correction. But when we do get the correction, we're going to get the Fed put. There's just no way around it. You have to print more money. You have to expand the money supply. So that's number one. Number two, XRP there's no reason for you to be buying XRP over a stable coin. Fully agree. Have absolutely no argument there. Number three, let's go back to the expansion of the money supply, because here's the problem. And you know this, Mike, you know this, you're a bond trader. We do not have real returns in bonds. We do not have real returns in bonds. The return for owning a treasury is a negative real return for anybody who's held them over the past however many years, since at least 1971. So if you're looking at bonds and you're looking at Tether and you're looking at USDC as a store of value, you're making a mistake. You can put your money there, but you're going to lose money on it. Why? Because you're putting your money in the US dollar. The US dollar is a great and will continue to be. I am not one of these maximalists who think that in the next few years, Bitcoin's going to overtake the US dollar and it's going to become the global reserve currency. The dollar is going to continue to be the global reserve currency, and USDC and USDT are going to be a key part of that, because it's going to enable people to buy treasuries anywhere in the world very easily and put them on any platform that they want to be in. And by the way, we haven't even talked about SOB 121 being repealed and the fact that banks are going to be able to hold all these things too. But now, why would they hold Bitcoin? Why? It's not because it's the oldest crypto. It's not because it's the boomer crypto. It's because it's the only one that's fully decentralized. It's the only one that is completely trustless. It's the only one that cannot be expanded. That it's going to continue to take market value as the US dollar continues to debase. Bitcoin will continue to rise in value. It's that coefficient. There's just no way around it. Now, I did share something I'm going to tease Dave back up here. I did share something, Misha, if you could bring it up, talking about the expansion of the money supply and liquidity. There you go. So this is Michael Howell. He does a lot of work on global liquidity. You can see that global liquidity bottomed out in this mini cycle. Okay, he says there's like 4 to 5 year cycles or 5 to 6 year cycles on the total money supply expansion and contraction. But in this little cycle, we bottomed out at the end of 2024, beginning of 2025, and we have risen sharply. Okay, why does that matter? It matters because we've been talking about this. I've been saying this for so long that you have Bitcoin got way ahead of itself. Yes, we all agreed. So the question was Bitcoin going to correct down 50%, or was the money supply going to come up and meet it somewhere? Well, we could see what's happening. It's meeting it. Remember, this is a money supply curve that's delayed by 3 months, because it's the way that because Bitcoin lags. But look at where it's about to touch. So I just disagree wholeheartedly that we're going to see Bitcoin at $10,000. That makes absolutely zero sense to me.
The United States is not alone in its uncertainty. Although China's monetary policies are still mainly unknown, James Lavish notes that it is generally assumed that the nation would continue to increase its money supply in order to maintain economic expansion. This reinforces the notion that ongoing money growth is required to avert a debt crisis and feeds into the larger global liquidity cycle. In his concluding remarks, Lavish highlights a crucial lesson. Continuous liquidity development is essential to the global financial system. It is absurd to expect governments to suddenly prioritize budgetary responsibility. The truth is that debt issuance and monetary expansion are here to stay, despite continuous political arguments about deficit spending. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
The reality is what Dave said, is that we live in a debt-laden society. There's no way to continue to have economic expansion without it being nominal. We have to have nominal expansion. Jeff Booth talks about this all the time, and you have quoted him before, Mike, talking about this, and that's the fact that you have this deflationary pressure of innovation and technology. It's reality. You've got I can pick up my phone and have access to millions of songs here. I don't have to go down to Strawberries or Tower Records to buy a CD for $15 anymore. Most of the people on the show don't even know what the hell that means. The reality is that you've got millions of songs at your fingertips for like 12 or $15 a month now. It's just insanity. Okay, so that is tremendous innovation and deflationary pressure on that industry. So why does it still why are those people still worth hundreds of millions of dollars and making so much money? Well, part of it is because global distribution, but part of it is just because the money it's just not as worth as much. You continue to debase the currencies, and I agree with Dave wholeheartely. And it's not just the US, it's a global phenomenon, and it must continue. And if we're gonna the reality is that inflationary pressure versus deflationary pressure that's what you see when you have these central banks step in and have their put. They have to expand the money supply because we are living on debt. And look, I want to make this clear again. I've said it many times before, but the reality is that debt is okay if you use it in a responsible way. What we're finding out is that we are not being responsible in the US, and the whole globe is not being responsible with using it. We have no idea what China is doing, except we can pretty much all agree that they're going to expand the money supply rapidly to keep the train going, which, to quote Lynn Alden, another one that we love here, is that nothing stops that train. Nothing stops this liquidity train. It has to continue to expand, because otherwise all this debt is going to be an avalanche that we can't get out from under. It's already bad enough. So as much as I love what Elon and Doge are doing, they're not going to balance the budget this year, and they probably won't do it over 4 years. I would be shocked. Pomp thinks they will. I just don't see it. But they're not going to balance this budget. We're going to continue to operate in deficit. We're going to continue to issue more debt, which means that we have to have those stable coins and that legislation to have buyers of this debt around the world. No, BRICS is not going to come up with their own currency. But yes, they're going to find ways around the dollar unless we give them a really easy way to hold it without being subject to being confiscated because they didn't do something that we wanted them to do.
James Lavish highlights that our global economy is driven by debt, and that in order to maintain growth, the money supply must be continuously expanded. He clarifies that inflation, not actual productivity growth, is the main driver of today's nominal economic expansion. The transition from purchasing CDs to streaming unlimited music for a small monthly charge is one example of how technology developments lower the cost of goods and services, according to Jeff Booth's theories on the deflationary influence of technical innovation. Businesses and individuals continue to create wealth in spite of this deflationary trend, since currency devaluation is eroding the value of money itself. Lavish contends that this is a global phenomenon rather than merely a problem in the United States. To avoid a disastrous debt collapse, central banks must continue to increase the money supply. He notes that in order to maintain growth, China is anticipated to pump liquidity into its economy despite its ambiguous monetary policies. According to Lavish, the truth is that deficit spending will never stop. Governments will continue to issue more debt, and attempts to balance budgets are unlikely to be successful. This implies that new financial products and stablecoins will become more crucial in meeting the demand for debt on a worldwide scale. Alternative financial systems, such as BRICS, may attempt to avoid the dollar, but their success will rely on whether they are provided safe, liquid alternatives free from political risk. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.